For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. All right. Hey, welcome all listeners near and far. Professor Rick Plum. Oh, I'm Johnny Dean, your podcast host. I think everybody knows who we are now.
Hopefully.
I would
We've only
hope so.
done 100 and some odd, 190, 191.
This is like 193, I think. Yeah.
I lost count.
I know. I keep bringing up this
Episode
200
number.
This 200th episode. We've been talking about this for a long time. That's coming up. I won't even know we've hit it, because somebody just tells me what episode number it is. Anyway. So welcome to the show. Professor Rick Plum is a certified financial planner professional and an accredited wealth management advisor.
Yay.
I don't even have my cheat sheet here today.
I know. That's awesome. You're
It
getting
is.
better. You're
I
learning.
am getting better.
Old dog, new trick, done.
Which is not my normal MO, but this time I happen to have said it often enough. Yes, you are the advisor part of this, and I am the podcast host part of this. We're going to get into the topic of filling your buckets here in just a moment, and in some ways, filling each bucket is easier than you might think, but on the other hand, it's probably more complicated than you think. We're going to keep this fairly simple as well, just as do as good a job as we can on that. But before we get to that, this is apropos. This is not part of the topic at all. But you happen to mention something to me. You met with a client in the last day or two?
Well, actually, what we're talking about is an email that I received.
Oh, an email. Okay. All right. So this brings up a really good strategy point, and I can't make an entire show out of it, but I think it's something that people need to be aware of when we're talking about, I don't know that we mentioned this when we talked about charitable giving. Tell me what happened with your client. Tell us what happened with your client and what the advice was.
Well, we have a client that's going through a career transition. They're moving from one area into another area, and they're building up their business. So this year, their income is going to be lower than historically, about a third of what they've been making in the past.
Okay.
But the employer that they had before, they had an ESPP, employee stock purchase plan, and they had restricted stock units that have vested, so now they're just stock. So they had a pretty decent amount of employer stock. Now it's a former employer stock. It's all vested. Yeah. They have every right to sell it or not sell it as they see fit, and they were holding on to it. And at a year or so ago, it was $250,000. It's a nice number.
$250,000.
Yes,
Okay.
it was a nice number. Now it's closer to $400,000. That stock, for whatever reason, after he left, no, I'm just teasing, took off and it has gone up substantially.
That's a lot
in the last year. And so he's looking at it and saying, should I be selling some of this? Because it's up a lot more than anybody expected. I said, yes. I mean, we can talk about that. But there's a couple things to consider, because he also said, I'm going to tithe 10% of whatever I sell right off the top.
Okay, so whatever he sells, 10% is going to go to a charity.
Right. He's going to make it, a gift to his charity.
Okay.
And so I said, well, let's talk about a few things. First off, the tax consideration. How much, because his income's down this year, he's going to have some room in the 0% long-term capital gain tax bracket.
Wow.
So before we get into the discussion of how much profit or gain should we take, let's talk about how much tax and profit and gain we can take without paying any federal income taxes.
Sure.
Now, he lives in a state with a state income tax, so he's going to pay some state income tax, but he can avoid. So we were going through and calculating how much he could take, and there was a decent amount, $90,000 to $100,000 of sale proceeds, and the gain of obviously going to be less than that because he has a basis in it. So he'd be able to sell $90,000, $100,000 worth of stock and stay in the zero long-term capital gain tax bracket because his income is quite depressed this year. And so then that would then also help him continue to fund his life while he's going through this transition.
Sure.
So there's multiple things going on. But I said, one of the other things you may want to consider is, let's figure out how much stock you want to sell. Let's say you want to sell $90,000. I'm just making that number, because that kind of came in early. Instead of selling $90,000, and the basis is about half,
and giving
the sale proceeds to the 10% of the sale proceeds
to the charity.
Let's figure out how much you want to sell, $90,000, and then let's take 10% of that in the form of stock, and let's pick the lowest basis stock and give the stock directly to the charity
instead of
selling it, incurring the capital gain. Because if he gives the stock to the charity, he can then write off the whole thing, assuming he can take a deduction for it. And he doesn't have to pay taxes. So if, let's say he was going to make $90,000 a sale proceeds, he was going to give $9,000, 10% to the charity. Well, let's take $9,000 worth of stock and give it to the charity. Either way, the charity's just going to turn around and sell it. In fact, most charities have rules, or I think they all do, where they have to sell it right away and turn it into cash. So the charity's going to get the $9,000 in cash either way.
And they don't pay tax.
The difference is now he's reducing his long-term capital gain exposure by $4,000 or $5,000.
Sure.
He doesn't have to pay tax, or he has that much more room in his 0% bracket to take more profit. And so it's just a much more efficient way. When we're dealing with making gifts to charity, what you give can potentially matter. Obviously, while we're alive, we can't just give IRA money because we're being taxed on that money. But appreciated stock, we can give that and avoid the capital gain. Now, if my income is $100,000, I can't give $1 million worth of capital gain. There are limits to how much stock I can give and still take the deduction. In his case, all of these fell within the limits, which is fine. But it's just more efficient.
Well, so the upshot of that is this: that if you're going to give money to a charity, and you're thinking about selling stock, let's say that you own personally, to create the money to hand to the charity, it may be a better idea. In fact, maybe in most cases, it's a better idea to just give the stock.
Yeah, give the stock directly, transfer the shares.
Yeah.
Now, even if you're not looking to pare back on the stock, and you're looking to make a donation, if you've got really highly appreciated stock, I know people that have some stocks that their basis is about 10% of the current value.
Which means you're going to pay a lot of taxes
if you ever sell it. So you got to hold on to it until you die so you can get a step up in basis. You may still want to give the stock and then take the cash that you were going to give and buy the stock back. So now your basis is higher on that. You still have the same amount of stock. The charity got the same amount of money. Your cash is down the same way either way, but now you're averaging your basis up.
Which is better when you go to sell it
if you ever want to sell it in the future.
See, these are, now, I don't know if I hope folks followed what you just said. I know where you're going, so I'm able to follow that. But believe me, that's a really good strategy.
Gifting is always interesting.
It really is.
We had one recently where somebody's making large annual gifts. They have some significantly appreciated stock, and they've got some personal money, but they can't use the entire gift with this appreciated stock because then they can't deduct it because they can only deduct so much. So they're making a combination gift between taking money out of their IRA. They're not 73 yet. They don't have RMDs. Taking money out of the IRA, which increases their adjusted gross income, and giving appreciated stock, which then they get a deduction for. And they can, now they're getting to use everything at their, and because they're doing it every year for 10 years, we can't carry it forward. Because at some point we're going to run out of the carry forward. I mean,
I love how excited you get about
this. It's fun.
It is fun. Well, that's why people come to you, Professor Plum. All right, so just I wanted to throw that out when you mentioned it to me. I said let's just put that in somewhere. It's a wonderful strategy to think about if you're giving money to charity and you have some highly appreciated stock. Maybe it's a good idea to just give the charity that stock.
Sure,
that's all. That's the gist of that. All right, let's pivot now and talk a little bit about buckets. We do get questions on buckets quite a bit. In fact, since we've been talking about it last season and a good portion of this year, it's created more questions. And one of the questions we get from many individuals is, okay, well, you've got, let's say in a standard 3-bucket system, what do you fill the buckets with? I mean, how do I determine what goes in each bucket? So, Professor, let's take just a little bit of time with we'll do a 3-bucket system and talk a little bit about what you like to see in each bucket. And I know it varies.
Lots and lots of assets is what I like to see in each of the buckets.
That's always nice too, correct. And maybe not a lot of income needed. But
well, no, if I have lots and lots and lots of assets, I can deal with lots of income.
Well, that's probably true. Well, let's talk about this. So let's start with bucket 1, which is a lot.
Well, let's go back to what is bucket number 1. What is the purpose of bucket number 1? The purpose of bucket number 1 is to create a pool of money that I can draw down principal and interest over a period of years. The first years of my goal, normally retirement, but it could be education, it could be other things, where I have to have that income. I have to have that cash flow. And so the priorities within bucket number 1 are stability of principal, liquidity, and then down the line a little bit is rate of return. What I want the most out of that bucket is I want $1 to be worth $1 when I take it out of that bucket.
Sure.
Whether it's this week, 2 weeks from now, a year from now, or 2 years from now, or even up to 5-6 years from now. I don't want to lose money.
Right.
I don't want to be put in a position where I have to sell something to create my cash flow that I need to sell something that's in a negative position. So bucket number one's priorities are stability of principal and liquidity. I want to make sure I can get to the money too.
Which means not a lot of rate of return.
In today's world, it's better than it was.
Comparatively better, but historically, it's not
it's
huge.
the lower yielding, lower returning area.
All right, so what do you like to see?
Buckets.
What do you like to see
in today's world? I see laddered bond portfolios, laddered treasuries, CDs. I see a combination of things, laddered bonds and or fixed accounts of some form. Fixed accounts could be, CDs, which are fixed accounts. And when we get out longer, and this is where liquidity comes into play in many cases, and if the accounts are large enough to make it work, fixed annuities for years 3 and 4, and then maybe a 5-year fixed annuity for year 5, 6, and 7. Why do I say that? Because annuities have surrender charges. The money's difficult to get to. It's not liquid. It's so for the first 3 years, 5 years, whatever. So we want to make sure if I need $100,000 a year for my bucket number one, easy math, I need 7 years worth of income. So I need $700,000 in bucket number one. The money I need next week, next month, I'm using high yield savings accounts, things of that nature.
Totally liquid.
For the early money. Yeah. And then I'm laddering treasuries or CDs for the next several years. And then when I get out to 3 years, so I need $300,000 for years 1, 2, and 3. But then I could also use a fixed annuity for years 4 and 5 because the surrender charges, you can buy them, that the surrender charge goes away at the end of 3 years.
You're not touching
It's like
this
a 3-year CD from that, other than it's not FDIC insured and it's issued by an insurance company, so stay with a good one. But they usually, at that length of time, have a slightly better rate of return than you would get with a Treasury or CD. And so I can then, I'm laddering with the best available assets that I can find, best yielding, given the priorities of liquidity for that particular time period. And now I've mentioned CDs and Treasury. It was interesting. I was just looking at these the other day. Which one do you use? Well, if it's in an IRA, I really don't care.
Well, because the treatment's the same.
The tax treatment when the money comes out is ordinary income. If I'm using personal money, it was interesting. I was looking at a comparison of CDs, 6, 12, 18, 24, 30, 36, going out, laddering them out. The difference now in certain states where you have a state income tax, our home state has a pretty nasty state income tax.
Yeah.
CDs are subject to federal income taxes and state income taxes. Treasuries are subject to federal income taxes, but not state income taxes. So I'm looking at the difference between the CD and the Treasury to see what is better, even net of the California income tax.
Wait, you said they're not taxable at any state?
Treasuries are not taxable in any state, no.
Okay.
In California, it just happens to have a high tax.
Well, that's where we're sitting, but people in other
Oregon,
states,
very high income tax for most people. So if you're in a state that has an income tax, one that's an income tax that's more than like 1 or 2%, you're going to be looking at the differential return between the Treasury and the CD. And what I found was at this particular point in time when I was looking, doesn't always work this way. The difference between the CD and the Treasury in the 6-month and 12-month was not a very big difference. And so I would stay with the Treasury to avoid the state income tax. But once I got to 18 months, 24 months and beyond, the difference in yields were significant, and the Treasuries were a lot lower than the CDs. And so I could buy the CD, and even after paying 9 or 10% state income tax on that yield, which is where California is at, I still had more money than what I would have earned on the Treasury.
Wow.
So understanding where you're buying it, what you're buying, and why you're buying it has a lot to do. Both of them have guarantees. Both of them were maturing at the time I wanted. So I'm trying to compare apples to apples as much as possible. I'm trying to compare yields against each other as well to make sure that I'm getting the return as efficient as possible. And the only people that are worried about this are people that have fairly large buckets, 1 and 2 and 3, where taxes do come into consideration.
It's true.
It does. It leaves a mark.
That'll leave a mark. Well, that's a lot of work. I know you like to do that. I would like my advisor to do that for me.
It's weird stuff, I know, but
well,
it's
no,
fun.
but here's the thing. You said for bucket one, the idea is you got to stay within the parameters of
What you're doing. Why
Yes.
are you? One of the things about a bucket strategy is it identifies the investment for what you're trying to accomplish.
Exactly, yes.
It'll tell you how much money you can actually afford to have at risk in stocks because you've gone through the exercise of bucket 1, 2, and 3. And bucket number 3, this is a strategy. It's not this age 100 minus your age BS. It's a matter of this is how much you can afford to have in stocks and afford the volatility of the stocks.
Yeah.
And saying that means the rest of the money you can't afford to have it in stocks unless you want to take a lot of risk.
Yeah, and that's what we're trying to avoid with this. So you like laddered CDs in bucket one.
I like fixed accounts.
Yeah.
Of some form.
Of some form. Now you did say, just very quickly before we move to bucket two, you did say one of the keys is liquidity, but you also
At
said
the appropriate time.
yes. So just so that people aren't confused, bucket one is about a set. Let's call it a 7-year time period.
Yes.
So some assets are going to be totally liquid now over the next year, maybe two.
Because I'm going to spend it in the next year. I can't have a surrender charge or a back end, early withdrawal charge on it if I need to get to it.
But you can afford to give up some of the liquidity for years 4, 5, and 6.
Yeah, because I've got money set aside, other money set aside.
And you've got
it's kind of like bucketizing the bucket.
That's exactly what it is. All right. So that's bucket one. Let's move to the more difficult one here. Bucket two.
And bucket number 2 is, I think, one of the most difficult ones because it is, we've got bucket number 1 in place. So that means I do not need to touch or draw down any of the principal or interest and earnings in bucket number 2 for at least 7 years.
So you're talking about money you won't need for between years 8 and 14.
I'm going to need to start drawing on it in year 8. So I want bucket number 2 to have I want to have a very high confidence that I will have all my principal plus some earnings in bucket number 2 starting 7 years from now. So there's different things you can use, and depending upon whether you're a conservative or aggressive investor, there are different ways to look at it. You can continue to ladder bonds out that far. I personally don't like that because the rates of return right now are actually coming down the longer you go, and I think you can do better with other things. For the more conservative investor, you can buy a 7-year fixed annuity that guarantees you like 5.5%. Haven't looked today. I don't know the exact rates today, but call it 5+% on bucket number 2.
This is as of mid 2024 for people listening later on.
Yeah.
Yes, these rates are subject to change.
But you might say, well, I want to try to get a better. You can use a fixed index annuity that has a 5 or 7 year surrender period on it, so that when you need the principal, it's totally available to you. A fixed index annuity has a guarantee of principal. You cannot lose money in it over the period of time, and you get a rate of return that is paid out, an interest payment that's paid out that is based on the movement of some index. The most common is the S&P, but there are lots of indexes. And so you look at the index, what did it do? And you get the index return subject to a cap or some kind of watering mechanism because you don't get it all. You're not investing in the index.
Well, you cannot invest in the index, but you're investing on something that mirrors it.
Right. And you're investing in something that mirrors it, but also you don't get all of the return either.
No.
It's subject to a cap. It's subject to a participation rate. These are the things that, while it looks easy, it's got some complexity to them. But the most traditional investment in bucket number 2 is this is where a typical balanced portfolio actually comes into play. And this is where you could use a target date fund if you wanted to. So it's 2024. So you use a 2030 or target date fund, and because you're going to need this money in 2031. But you don't leave it there after it hits its target. you move it to bucket number 1 as you get there. But a balanced portfolio, 60, 40, 50, 50 balanced portfolio. But there's volatility with those. But I'm not as concerned with some volatility because I know I don't need to touch this money for a series of 6, 7, 8 years. Now, bucket number 2, we can also bucketize the bucket and go with a more secure, or maybe something that has a little less return but more principal protection or more downside protection for years 8, 9, 10, and years something that may be more aggressive for years 11, 12, 13, 14.
Because you've bought time.
It's all about time.
Yeah.
So all of these things are for bucket number 2.
Wow. That's
I've even seen a very high quality dividend paying stock portfolio which tend to be a little less volatile than the market as a whole. still volatile, but less volatile, and high dividends, which you reinvest your dividends. And so use that for some of bucket number 2. And so you can then hopefully get a better than the expectation is 5-6% maybe on bucket number 2. And you're trying to hit expectation plus, because you want that, and then you're actually hoping to outdo it. Right. So you set your planning parameters up based on a low expectation.
And if you get
and if it all works with a low expectation, you don't have to hit home runs.
Well, and here we go again. We talked about needing a margin of error.
Mm-hmm.
Allowing for, I'm good at this level. If I get something better, fine.
Yeah,
but there's that margin of error, so important.
Yeah, it's like when we're dealing with people that have pensions that have cost of living allowances.
Yeah.
I typically in my planning process don't use the cost of living, even though I know it's there, especially if it's a federal government or a municipality. That we know that the it's going to be there. But if I can make it work, if I can make your plan work without a cost of living adjustment, it just gives you more room for spending you didn't know you were going to have.
There's that. There it is again.
It's just a little wiggle room. I like wiggle room.
I love wiggle room.
Yeah.
And that's why to me, and I've said this many times, I want to know worst case scenario. Just give me what I can.
Well, we can't always plan for worst case because we don't. In many cases, we can't even imagine worst case.
Well, I shouldn't say it for that. I'm saying what's the least amount that I'm going to get.
Let's be conservative in our assumptions.
There you go.
Understanding that we cannot account for every possible negativity that the world can throw at you.
No,
we can account for a lot of them.
Well, we can, and you can do just as good a job as you possibly can.
So bucket number 2 has the most flexibility, the most variability of investments. If some of it has to do with whether you're buying it inside of an IRA or outside of an IRA, you're looking at the taxability of it, things of that nature. You're saying, okay, how do I make this work for myself? True. And not, shoot myself in the foot from a tax standpoint.
Well, the thing about bucket 2 is we're talking about years 8 through 15 or something, right?
Yep.
Year 8 really, you're talking about the beginning of bucket 2 needs to have, as you said, more of a principal protection because 8 years is not a huge amount
We've
of
had
time.
8-year periods of time where stocks did not perform positively.
But when you get up to years 13, 14, 15, there's a little more flexibility on that. All right, so that's bucket 2. Let's move to bucket 3.
Well, bucket number 3 in many cases is the easiest one.
Yeah. Because
we know that we have a long-term time horizon. Liquidity is not important. I don't have to have access to this money for up to 15 years. And even if I'm going through my buckets a couple of years, 12, 13 years, 10 years, I have time. So liquidity, accessibility is not a priority. Stability, I don't care. I expect the fact that I'm Murphy, and Murphy's Law says the day I invest is the day before the market crashes. I expect the market to go down several times over that 15-year period of time. It's going to happen. Whether it's a big one like 2008 or 2000 to 2002, or a quick one like 2020 in the COVID time. Right. Those were all negative years or negative time periods. Yes. 2020 was actually a positive year. So I expect volatility. I want volatility in my bucket number 3 because that's the only way to get the rate of return after a 10, 15, 12 period of time.
Yeah, and bucket 3 is, Professor Plum, really where you're looking for rate of return.
And that's where you use stocks. A diversified stock portfolio. Now, one of the things I've seen is that people take diversification too far.
Well, we've said it's possible to be over diversified, sure.
Where you have 30 mutual funds, and each mutual fund has hundreds of holdings, and even if you had XYZ stock that went up a gazillion % in 1 year, you had less than 1% of it in there. Yeah. It made a difference of almost nothing in your overall portfolio. So diversification is important. Just make sure you're not overly diversified. Now, this is the basic 3 bucket. And before you get to the basic 3 bucket, you have to understand whether or not you wanted to add some lifetime income, pensionized income, and things of that nature as your 4th bucket. And within bucket number 3, maybe you're going to add some alternatives, so some different hedging strategies and things. But those are all within parameters of how are we supposed to be investing the money? How much money do I have to invest? If my overall allocation is $200,000
to bucket 3,
no, to my entire portfolio.
Oh, I'm sorry.
I don't have as many options for bucket 1, 2, or 3 as I do if my overall allocation is $2 million or $20 million. I have more options when I have more money because certain investment strategies, especially bucket number 3, require X amount of dollars before they become efficient to be able to use them. And so, I know some really exciting, fun portfolios, but they've got $2 million minimums. And that's $2 million of your, not of the whole portfolio, that investment. And it should not be all of bucket number 3, which means your bucket number 3 better be more like 4 or 5, which means your overall portfolio better be $15 million.
Well, the nice thing about bucket 3 is that you've bought time, and that's the whole
goal.
Key. Yes.
But going back to what is the need? What are the parameters I've set for that bucket? Bucket number 1, stability, liquidity are the primary 2. Bucket number 3, growth. I don't need stability. I don't need liquidity.
You're not going to get stability.
Well, there are people that are very conservative, and they will go and they will use things like that fixed index annuity that has no risk of principal
in bucket 3.
In bucket 3, because they don't want to see losses. And if their income needs are low enough that they don't need, it goes back to why take risk if you don't need to? If you've got $1 million and you only need $10,000, $15,000 a year from it periodically, you don't need to take any risk. Why take risk? Unless you feel bad that you're missing out.
There's the argument. There's the argument that 15 years, you've bought enough time where, but again, we're going to somebody's psyche.
The 15-year time horizon we've been discussing is something that you should decide with your advisor. Maybe it's not a 15-year time horizon. Maybe you only want a 10-year time horizon for buckets 3, and so now you got a 5 and 5 on 1 and 2, or you can do an 8 and 8. And so the time horizon is the debate on how long should bucket number 1 last? How long should bucket number 2 last? Bucket number 2 becomes a new bucket number 1. You turn it into CDs, treasuries, and things at the appropriate time. The appropriate time to rebalance or refill buckets, we talked a couple of weeks ago about the increasing glide path of stocks. And if we're drawing down our treasuries and CDs, we're drawing down all the safe money in the first several years.
Your ratio,
by definition, our stocks are going up as a percentage of the overall pie. At what point do we refill bucket number 1? Well, refilling bucket number 1 partly comes down to, what did I use for bucket number 2? Did I use something that has volatility in bucket number 2? I'm going to look to refill bucket number 1 sooner. Did I use something that has a guarantee of principal that I know is going to be there at the end of year 7? I probably won't refill bucket number 1 until the guarantee is gone. And so how you manage your buckets, how you manage the flow of money from 3 to 2, 2 to 1, depends on what you're investing in.
And that's true. And what you're investing in can often depend on your frame of mind.
Oh, heavenly, yes. Now, one thing that we were talking about charitable giving earlier, and it brought something up. How do required minimum distributions fit into all of this? How do you create your bucket strategy with RMDs? Well, you create your bucket strategy based on your spending needs, your expected spending needs. Maybe even pad that a little bit so you have more income than you really think you might need. Because I know that if you're just starting a retirement, you're going to spend more.
That's just the way it is. You're younger.
Yeah. It just happens.
Yeah, of course.
When we think we know what retirement's going to look like, and then we get into retirement and say, it's more expensive than I thought. But required minimum distributions come into, where are we taking the cash flow from? Are we using IRAs in bucket number 1? Are we trying to go without any taxable income for a little while to try to avoid some taxes? The RMDs, for people who do not need them to spend because they have enough pension income, not enough portfolio income, I'm talking about enough pension income, those do not have to be in bucket number 1, because I don't have to spend my required minimum distribution.
You just pay tax.
I just have to take it.
You have to pay taxes on it.
I have to. Yeah. I have
take
to
it
create
out of the IRA.
A taxable event to satisfy the Congress. And so RMDs should be calculated and worked into a spending strategy. But if you don't need to spend the money, we can do RMDs by just moving money from bucket 3 to bucket 3 without selling a dang thing. Just pick up assets out of bucket number 3 and move them to bucket number 3, and from your IRA to your personal name. That creates a taxable event. The only thing is, you got to have the tax. You have to have the money to pay the taxes.
But you're going to have that anyway, because you have required minimum distribution.
But if I'm using my IRA for spending, I've got the proverbial $1 million portfolio, and I need $40,000, $50,000 a year. Well, guess what? We're going to create the buckets to create that $40,000, $50,000 of cash flow, but it's going to be coming from the IRA, because we have to take it from the IRA anyway. So bucket number 1 should be part of the IRA in that respect. So you build the spending into the location, but the RMDs don't have to be spent.
See, did you think, you folks listening, did you think buckets was really easy?
It is.
Yeah, for you. I just, as I listen to this, again, I come back to there's a bucket strategy out there somewhere, and there's the bucket strategy. And this is the bucket strategy. There's really only one way to do it.
And charitable giving is part of your bucket strategy too. Is your charitable giving a one-time thing, just random, or is it every year I'm going to give cash, or I'm going to give my charity X, and come heck or high water, I'm giving that charity. That comes into your planning process.
Here we go back to the charitable giving, which we started 30 minutes ago. Look at you.
I tried to bring it full circle.
Full circle. Circle of life. Well, look, I tell you what, if you want help with this kind of stuff, you need to talk to Professor Rick Plum, any of the Lucia Capital Group advisors. 800-644-1150, 800-644-1150. They'll talk to you. They'll actually kind of get an idea of where you are with your risk tolerance. How do you feel about potential, having money in a bucket 3 where there may be volatility over the next 15 years? Take all that into account, and then at that point, they will decide how they're going to fill the buckets. You said bucket 1, just to summarize, more like CDs, laddered CDs, treasuries, things like that.
Fixed accounts.
Fixed
in many
accounts.
cases.
Yep. Bucket 2.
Strategic bond portfolio could work for part of it.
Bucket 2 is perhaps longer term fixed
index.
Or
it could be fixed annuities, but balanced portfolio is the most traditional. Structured notes.
That kind of stuff. And then bucket 3,
stocks.
Can be stocks, right?
Real estate.
But each individual, each person has their own individual needs, wants, that kind of thing, risk tolerances, and that's why the bucket strategy is formulated around that first. Mm-hmm. We determine what that is. 800-644-1150. Talk to the people at Lucia Capital Group. If you have not done so, many of you have not. Do so and find out, what do I fill my buckets with? Let's talk about this. You can also go to luciacap.com, luciacap.com. You can find the Bucket Strategy Guide there. This will give you a lot of this information we just talked about, not necessarily from a strategy standpoint, but
gives you the concept.
Yeah, and it's important. I think it's important to understand the concept if you're going to do a bucket strategy. Go to the search bar there at the top at luciacap.com. Type in Bucket Strategy. Right?
Singular.
Bucket. Or bucket. Yeah, not buckets. But type in bucket strategy. That'll give you the first result. Then you can download the PDF and read it at your leisure or possibly leisure, depending on where you're from. The Social Security Guide is there. You can type that in, and an estate planning guide as well. So that's all at luciacap.com. Subscribe to this podcast, would you? That's a direct order from us to you. Subscribe. Apple Podcasts, Spotify, either one. Download every single episode. Do not miss an episode of this podcast. Why? Because you got to find out what we're going to do on episode 200. Probably nothing.
Well, we're going to do a podcast.
Well, we're going to do a podcast, but it's going to be, did we have, what was that, a couple episodes ago? Did I miss that? Yeah, I think it was. So don't expect anything
We're
big.
not there yet, but
we're not there.
We'll think about it. We'll
decide.
Cogitate on what to do.
We will decide. I can't believe we were this far into the podcast. So make sure you subscribe. Thank you, Professor Plum. I'm going to let you get back to work because you're probably late for a meeting, but hey, we do this when we can. For Professor Rick Plum, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. No client or prospective client should assume that this information or any component thereof serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interests may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Fixed index annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Withdrawals prior to age 59 and a half may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies and leading industries. An investment may not be made directly in an index. Structured notes are considered complex investment products. They contain unique features, risks, terms, conditions, fees, charges, and expenses. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Before investing, carefully consider a target date or mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.